smoothly across all the platforms. Thank you, Chaitanya. So once again, a very warm welcome to all our participants. It gives me an immense pleasure to welcome you all to today's webinar and today's session under our rendezvous series. And today's presentation, as you can see on the screen, is titled Sustainability and ESG for Modern Professionals. This topic is extremely relevant in today's dynamic business landscape where transparency, accountability, and long-term value creation are no longer optionals, right? It is must. They are strategic imperatives. You cannot um, just deny it. Okay, so now allow me to briefly introduce myself. I'm Dr. Krishna Joshi from the DBA department at Uniathena, and at Uniathena, we are committed to delivering globally relevant, flexible, and industry-aligned education to working professionals and researchers across the world. It is now my honor to introduce to you all our esteemed speaker for today, Dr. Gyanendra Moharanjithan. He is an academic researcher and finance professional with over 20 years of experience in accounting education, corporate training, and financial consultancy. He is a lecturer and IFRS specialist. He holds a doctorate in business administration from UCAM. So he was with us at Uniathena and his DBA from UCAM. With research, his research focusing on institutional performance and sustainability in higher education. His areas of expertise includes ESG reporting and sustainability framework, IFRS standards, corporate governance, financial performance analysis, and strategic financial management, and many more. So Dr. Gyanendra has delivered numerous professional training programs for finance professional and banking executives, particularly in sustainability reporting and enterprise level financial strategy. What makes his work truly impactful is his ability to integrate academic research with practical industry applications, supporting responsible and sustainable business transformation. We are truly privileged to have Dr. Gyanendra here. Before I formally I hand over the stage before we formally begin, a small instructions for all our participants. You are most welcome to post your questions in Q&A section box throughout the session. Please feel free to note down your queries as they arise throughout the session. We will try to address all the questions as per the time permits us. We will try to address the questions during the dedicated Q&A session at the end of Dr. Gyanendra's presentation. So I would like you to hold on your queries. Please write it down into Q&A box, and we will surely come at stage where we will be discussing those question and answer. Now, before I again hand over stage to Dr. Gyanendra, just let me share that what you can expect from this session today. So by the end of this webinar, participants will be able to explain the purpose of sustainability reporting, understand global reporting framework, IFRS disclosure requirement, understand how sustainability risk affect enterprise value, and how they can apply sustainability reporting concept in practice. This session has been designed to bridge theory and practical application. So without further delay, I would now like to hand over the session to Dr. Gyanendra Mohanrajithan. And sir, the virtual stage is all yours, and a big welcome from Uniathena.
Thank you very much, Dr. Krishna and Dr. Adira and also Ashwin. And let me begin my discussion. Yeah. Very welcome to all this very good topic of sustainability and ESG for modern professionals in the current context world. The contemporary world is now looking at this particular concept in a very wide concept, and also expecting this corporate world to apply that to the great extent. And also this particular topic is now a very emerging topic, and a lot of researchers are going on in this particular topic, where every researchers have to identify the new innovative ideas to protect this world, planet, and the people. Okay, having said that, let me go back to the introduction of this. Now, why this topic is matters nowadays in practically, if you are looking at this particular concept is introduced long before, but it is no more voluntary nowadays. To a limited extent, it is now started as a voluntary part under IFRS, but most of the organization which are exposed to this sustainable issues and ESG issues are expected to be report in a very mandatory manner. So the corporate initiatives are expected in a voluntary manner is no more applicable now, and they have to do it in mandatorily. They have to report on this particular sustainability and environmental, social, and governance issues. Next important point is this is connected to the risk management discipline. So it is considered as a wide risk impact on the corporate companies, and every corporate companies are expected to embed the sustainability and ESG issues into their risk management discipline. Thirdly, if you are looking at these factors which is affecting to the organization, is having a direct impact on enterprise value. The value chain system of the organization is getting affected due to these environmental and social factors, which are not going to be addressed by this organization to the great extent. And also, if you are looking at from the market, that is financial market perception, every sustainable and ESG issues are connected to the valuation of the company, and especially lending decisions are made by financial institutions or the organization which are adapted with sustainability and ESG issues. And most of the companies nowadays, they are taking decisions because they wanted to make sure they need to make the three important people satisfied, especially the shareholders and investors, and also these regulators have to be addressed properly on these particular sustainable issues. Therefore, the capital allocation is also mostly decided based on how well these organizations are addressing sustainability and ESG issues. So in other words, the capital allocations are now taking place in corporate world, mostly toward sustainable projects, which are giving good return for the organization. I will come to all these definitions shortly, but first of all, understand why this topic is matters nowadays. And IFRS sustainability disclosure standards providing the global baseline where it is going to be mandatory very soon. It is almost coming to picture, but it is now going to be further emphasized on adaptation of these mandatory requirements. Having said that, in this particular webinar, what objectives you will achieve, say, what do you mean by sustainability and what is the purpose of sustainability reporting? Then secondly, understand the global reporting framework, which is created by ISSB, International Sustainability Standards Board, and they are giving a lot of guidelines and framework for the organizations to be adapted with. And under that is ISSB, there are two IFRS that have been created. IFRS S1, Sustainability 1, especially coming under the general disclosure requirements of all the organization, which are connected to the sustainability and ESG issues. And IFRS 2, that is IFRS S2, Sustainability 2, is leading to the climate disclosure requirements. So these two are now becoming mandatory from 1st of January 2025. So almost the first year financial information has been prepared, but depends on the jurisdiction. It is now becoming mandatory. Some countries are still not made it mandatory in their regulatory framework. And understand how sustainability risk affect the enterprise value. So sustainability leading to a huge amount of risk to the organization. And if it is not properly addressed and taken into consideration, it might affect the overall value of the enterprise value. So this is supposed to be embedded into their risk management techniques. And also the concept, how it has to be applied in practice, you will be able to learn limitedly in today's webinar. And now let's go back to what is sustainability is all about. Now, first of all, you need to understand people are talking about sustainability continuously, but they should know this has a very significant impact on long-term effect onto the entire societal well-being and even the planet, global presence, and also for the every individual living in this planet should be considered in long term. And all these corporate companies, what they are dealing with, they should always remember they should think about the next generation. So they need to have this intergenerational responsibility should be taken by every corporate companies into application of these sustainability regulations. And also, if you are looking at in long term, the natural resource utilization and economic system and also social well-being with the how human being can exist and live comfortably in this world also will be very much considered in sustainability requirements. And also you can see this how to manage this risk, and sustainability is leading to a severe risk impact to the entire value chain of the company, and how this can be evaluated in terms of environmental, social, and economic system to uh, develop some framework for every organization to address this issue in their reporting system. So having said that, the sustainability is one of the long-term application of our environmental concerns and governance issues, social issues, and economic conditions to be developed over a long period of time. And ESG framework, if people ask why ESG, why sustainability? Sustainability is going to be a main heading. Under that, you will be having something called ESG. So ESG is a financial language of sustainability, I would say. Because if you really wanted to talk about in terms of financials, so you need to break down the entire sustainability into three main categories: environmental, social, and governance requirements. So in environmental, we are giving a lot of importance for climate changes, carbon emissions, especially we are coming to greenhouse gas emission, and biodiversity, the living species, how it has to be protected in this planet, and also resources use. Mainly we are talking about the usage of water. So the water shortages are expected in another 20 years time. So how well this entire world is ready to make use of the water resources carefully and keeping that for the next generation who is going to be facing these severe issues. And social issues are mainly coming under the human being. We are looking at the employees' well-being, how well their human rights are being protected, whether the work-life balance taking place in communities, how well they are being protected, and also supply chain. So that means we as a responsible organization, we are not looking at from our end only, how our suppliers have been adopted, sustainable, the sustainability requirements and ESG regulations, especially. Now, see if you're, let me give you a simple example for that. And if your organization is dealing with some suppliers, and those suppliers are utilizing child labor to do any kind of a logistics management or whatever kind of a supplies towards the organization, that is one of your concerns, and they are also contributing for unsustainable behavior of your organization because you are connected with that supply chain. So these are some of the issues. We have to talk about that specific examples in later on. So when you come to the governance, which is the last one, the board combination and how well they are giving importance for the risk management in sustainability, and whether they are adapted with ethical conduct, and to what extent they are able to apply the control, all that will have to be leading to a governance. Basically, the administrative regulations which the governance management or governance which are taking care of will be coming under the governance issue. So basically, ESG refers to environmental, social, and governance. Under these main headings will have to be addressed by organization in detail. And what exactly we are trying our level best to do it at this point of time is how well these investors' confidence are being created on the corporate company in sustainability and ESG regulations. So customer also is involved in making decisions whether to deal with these kind of companies. So they also can contribute to the pressure or giving a lot of pressure for corporate companies to involve in better sustainability and ESG regulations. So having said that, we will get back to sustainability versus ESG. How do we differentiate between sustainability and ESG regulation? Sustainability is a broad concept, societal concept, as you know, and investor focus is the most significant impact, and ESG is breaking down into this analytical framework. So we can easily quantify the impact of ESG and find out what are the initiatives and what are the strategy that we need to adapt it for the purpose of finding solution for these sustainable issues in the organization. And also it is focused on the long-term development of societal and environmental concerns, and ESG focus on risk and opportunities that affect the enterprise value. What does it mean, these opportunities we are talking about? Risk and opportunities. Risk, as we know, it is an uncertainty and negatively affecting the cash flows of the organization, and also the going concern ability of the companies affected since they have not given importance for the environmental concerns and all. So what does it mean about these opportunities? In this case, how can we demonstrate the understanding of opportunities? Actually, if you are looking at from the climate changes which are taking place in every 3 years, the global warming is supposed to be increased by 1%. That means temperature is supposed to be increased by 1% every 3 years. If any company which is dealing with renewable energy, mainly the solar energy, those organizations can take this as an opportunity to invest huge amount of money on solar panels. Now, China is a very good example where they are investing a large amount of solar panels and generating a large amount of solar energy, which can be utilized as a renewable energy instead of using other type of traditional energies and so on. So therefore, the opportunities and risk need to be properly identified by the corporate companies, and they need to mitigate the risk and exploit the opportunity in order to get benefit for their value chain system. And therefore, ESG is primarily used by investor, lenders, and regulators. As I told you, these are the three important people, even including other stakeholders, but they are the people who are really concerned about. Investors, why they are concerned? Because they wanted to make sure their monies are invested in a right platform, which is having a long-term impact. And lenders are very much concerned. They should not lend money for any other reasons where it is damaging the environment and societal impact. Now, a good example is that banks are giving green loans. That means the project which are having a green projects will be given a chance for getting the lower cost of capital, and also they will be given permission before proceeding with any other loan facilities and so on. Regulators, mainly the policymakers and any other pressure groups, are very much concerned about sustainability and ESG regulations to be adopted in the environment where the corporate companies are dealing with. So let's come back to impact and dependencies. So these are the two important elements you have to remember when you are coming to IFRS. And every corporate organization should remember what is the effect they are creating on every activities of them to the entire society and environment. So the impact is how effect that you have created, whether it is leading to any significant impact on the societal well-being of the people, and are you creating any sort of a dangerous hazardous to the entire planet as such, or all that impact need to be evaluated first. And dependencies, if we are coming into that, to to what extent that you are relying on that particular resources. Say, for example, you are using certain amount of resources, say, for example, water. So the water usage is extremely utilized, and what extent you are depending on that and how well you have to deal with that resources in order to make sure it is not affecting the future generation. So how the company rely on natural and social system will be identified under dependencies. These two factors or two elements, we need to very carefully look at it in corporate companies while they are dealing with sustainable issues. Sustainability risk arise from both impact and dependencies. So remember that the impact and dependencies have to be clearly identified by the organization, especially dealing with this mass operation in environment. So having said that, why sustainability reporting is an emerging topic nowadays, we are not anyway looking at backward. We are looking forward thinking, and forward looking options have been now taken by most of the investors, because they are not looking at what is happening currently only and how we will be in the next 10 years or couple of years, also looked at by the investors. And climate changes, biodiversity, the living species impact, and also social instability create the financial risk towards the organization now, because all what you are doing has a cost. That means companies will be taken action by the regulatory authorities if it is not properly address those issues, and seriously if it is not properly aligned with an expectation of the regulatory requirements, there will be some sanctions and action by the government authorities. So in that case, it is creating financial risk and impact towards the organization. So that is another reason where this is becoming an emerging issue. And traditional financial statement do not capture these risks adequately. Now, if you are looking at the financial information, what you are preparing, do you think it is looking at the future sufficiently? Unless you go to the annual report and see how well directors have lobbied to these kind of sustainability issues and all, there won't be any much impact to be noted from the financial statement. So financial statement is not going to be addressed much on that. Unless otherwise you follow IFRS S1 and S2, you will not be able to get much impact on the financial statement. Now, the requirements are coming up and it has to be addressed by every corporate companies to embed that impact into the financial statement. So this is going to be the next phase anyway. And also, the sustainability disclosure frameworks have now been created where organizations have supposed to be adapted with. There is a two parts, we can say pre-ISSB and post-ISSB. So before ISSB has come forward and find out IFRS S1 and S2, there was too many regulations were included or introduced by various other organizations or various other frameworks, which is creating some kind of a confusion and inconsistencies in adapting sustainability. Now, post ISSB has come out with a clear indication, and they have given a framework where every organization is supposed to be adapted with certain regulations which need to be connected with the corporate reporting. So the disclosure, that is sustainability disclosure framework, is now coming up for the purpose of dealing with every reporting issues in sustainability. Yes, having said that, which I already identified that pre-ISSB, before ISSB, there were certain authorities and organizations were coming out with sustainability regulations. One of that is GRI, Global Reporting Initiative. Impact reporting for stakeholders have been identified. Even now, the GRI requirements are in force, but it is now they are looking at only the impact. But now we are looking at it a broader concept of financial implications, and also we are taking people accountable for whatever they are doing it. So there are two more additional steps have been introduced in current world pertaining to this sustainability reporting. And TCFD, it is a task force for climate related financial disclosure. Actually, the climate financial risk reporting was one of the practice which was followed from last 2 decades, but it was not seriously adopted, I would say, for the last 15 years. And the last 5 years only, it was started, a lot of natural disasters and unexpected rainfall, flash floods, all that has been happened in the last 5 years continuously for countries and regions. So there is a climate financial reporting framework has been identified as severely now all the organization dealing with the mass uh, industrial activities are supposed to be adapted with a climate financial reporting framework. Task Force for nature financial disclosures are also very important, because any activities done in the world by any corporate companies in a multinational industry, multinational organizations, creating impact in globally, should be addressed under the nature related risk. So that need to be identified from their product and services, how well they have damaged the environment, and that need to be addressed in line with the guidelines given by TNFD. Finally, European sustainability reporting standards, which we need to look at those two, IFRS and European standard, because if European standard started long before, and also they have given more rigorous application than the IFRS, because IFRS is a global uh, reporting standards where these European standards are applicable for the European countries alone, but they have some strong application, and they are making mandatory to the great extent than the IFRS in adopting sustainability reporting. You can also search for additional information, and you can go into the research articles how well the sustainability reporting is being addressed by European standards. So different objectives and materiality concept created inconsistency. As I told you, because of these people have come out with the different regulations of these organizations, had been created a lot of inconsistencies. Right. Financial versus impact materiality. Now, let's look at the materiality. As you know very well, IFRS is looking at the material transactions. Here, we are looking at first the materiality in financial platform. So, what do you mean by financial materiality? The impact which is created in terms of financial is considered another financial materiality. So information that affect enterprise value and investors' decision is leading to financial, because any price sensitive impact towards whether to invest in shares or not is leading to a financial materiality. And there is another materiality we always look at, impact materiality. So this is actually talking about how the impact has created on social and environmental activities. So financial materiality and impact materiality both considered by European standard. But as long as IFRS is concerned, we are looking at from the financial materiality. So materiality, in other words, the transaction is big in size. We need to take it into account. So any omission or misapplication of the transactions or financial transactions connected to sustainability has created a significant impact on the decision making, then it is considered as a materiality, and also in terms of financials. So financial and impact materiality both are considered in our standards, but IFRS S1 and S2 is mainly concerning on financial materiality. Why ISSB was created? Now, there was a lot of confusion, as you know very well. I was discussing before, and there are a lot of inconsistency. There are a lot of issue of comparability, and there are a lot of duplications were taken place because of any other different organizations were really looking at the different applications of the standards and so on. And a lot of confusion was created to the investors. Therefore, these all collectively has a significant impact on creating a new standard which comes under the ISSB, which created IFRS S1 and S2. Truly speaking, IFRS was created nearly not even 5 years completed. And in 2021, this ISSB has been formed, and 2023 June, they have come out with S1 and S2. They put those standards into effect from 2024, and early adoption is acceptable, but they mandated according to the IFRSs from 2025, 1st of January. So now 1 year has been completed. All the organization completed the financial statement 31st December 2025, if they have already incorporated the sustainability as part of their corporate policy, they would have adopted the ISSB regulations S1 and S2. And also remember, these organizations are expected to follow these S1 and S2 regulations and the framework which is as per the guidance. And 2025 or 2026 onwards, most of the countries have been decided to adopt it with this because of the past experience of sustainability is becoming a major issue for most of the countries. So regulatory authorities are now seriously thinking about it. Some countries have been adopted with their Vision 2040, and also they are moving towards sustainable country, as well as they are thinking about adopting this sustainability into all private sector organizations. So having said that, let us come back to S1. It is Sustainability Standard 1. Actually, here what we are looking at is a general purpose and also general guidelines to be adopted with sustainability reporting. So S1 is mainly identifying the prospects include the future cash flows, how sustainability adoption will have a reflection and impact on the cash flow of the company's future, and also access to the finance, because you will be able to get your company highlighted in the jurisdiction that you are operating, and you will be able to get large amount of finance from the financial market and also from the government authorities. Even the banks have been adopted. Some of the countries have mentioned that the banks supposed to be finance for the companies who are adapted with sustainable requirements of the country. So it is not seriously applied in every countries, but most of the countries are now taking that into seriously into consideration. And cost of capital, when organizations are adopted with sustainability regulations, please note the cost of capital can be reduced because the banks and other financial institutions, even the financial market, will attract towards the sustainable organization which can long standing, and also it is having a better financial strategies where they can give face to the going concern ability in the future. Therefore, cost of capital can be reduced if the sustainable regulations have been adopted in accordance with IFRS 1. So standard focus on information useful to investors and lenders, because they are looking at how well the banking institution can fund money to the sustainable projects and how investors can give money to the sustainable organization which is supporting for the environment and having a long-term stability in finance and other matters. So having then said that, then conceptual foundation. Now, as you remember, the conceptual framework is talking about certain conditions and requirements to be adopted in financial reporting, isn't it? So here, the IFRS S1 in align with IASB conceptual framework, they said whatever is relevant information supposed to be reported by organization under the sustainable reporting system. So the relevant information, if it is connected to the climate related activities, supposed to be reported. So all the organizations are not exposing to that. Now say, let us take one example of an educational institution. They are not dealing with large amount of resources. They are intellectual people who are dealing with some service providing for educating and conceptually making people to become educated. But those organizations will not be exposed. But with the mass scale production, manufacturing organization, some companies which are dealing with service via logistics management and all, they are dealing with. So any particular activity which are relevant supposed to be reported. And faithful represented. Remember, in conceptual framework, we have already identified any information which are reported should not be biased. It should be unbiased, and it should be complete information and neutral information. When you are following this faithful representation, your information is highly recognized in the platform of the stakeholders. So make sure the financial information is faithfully represented, especially in context of sustainability. Information should be comparable enough, to be, if it is adopted in the previous period, or if it is a matrix or whatever the targets you have trying to achieve, it should be comparable sufficiently for the stakeholders to make some informed decision. It should be timely reported. The information supposed to be given on time. Don't delay the information. That is a very fundamental requirements of the IFRS. And it should be reported in understandable and also with the very brief explanation without complicating the people who are really reading those information. It should be reported to the layman style where people can easily get to know about the sustainability reporting. So material information is the material information is information that influence the investor's decision. As I told you, not all the information will be looked at by the investors, which is going to have a reflection on the price decisions will be having a attraction by the investors. So having noted that, connectivity principles say we need to make sure the sustainability information must be connected with the financial statement, and also you should be sufficiently understand the relationship between the sustainability risk and what are the course of action strategy that you are taking one after the other in order to make sure the sustainable process has been taken place in the organization in order to produce the product and provide services. And financial performance, how well it has a significant impact on the financial performance, also been looked at by this standard. Actually, the connectivity should be clearly identified and reported in the sustainability reporting style. So this is another one more thing that we have already looking at, which is called integrated reporting. As you know, IIRC, International Integrated Reporting Council, has come forward with this IRC, that means integrated reporting, IR, we call this as IR. And that expected all connectivities, all interconnection between the variables need to be reported clearly and show the significant impact onto the value system or the value chain of the organization, and the holistic comprehensive reporting style need to be adapted with. So having stated that, we will come back to core disclosures structure according to IFRS S1 requires disclosure under 4 main headings. This is what you have to remember. As a person who is adapting with the sustainable reporting, you must make sure that the governance has been given due respect and importance to involve in sustainable reporting. So the top level management, the tone of the top should be identified. They should really embedded this sustainable concept into every activities of them. So the decision making is going to be decided based on how well this sustainability reporting has been respected in the board level. So the governance requirements are very much important here. Secondly, the strategy, the course of action, and the initiatives that they have taken one after the other. They have made different targets, or the target is coming last. But anyway, you need to have some kind of timelines to be decided when it has to be achieved, and how the process or the course of action is going to be taken place will be decided under the strategy. Then we'll come to the risk management, say identifying the risk which is affecting in every different levels for the organization to be adapted with this sustainability, and what extent that it is going to be absorb the finance into the organization, and how well it is going to be costly for the organization also need to be addressed properly in this risk management. So what are the actions taken to mitigate the risk by the organization? Because eliminating 100% is not possible. So somehow you need to report on these risk management techniques that you are following in order to mitigate the risk. And matrix and targets, we need to follow the guidelines given by S1, and also if it is not be able to follow the requirements by the the guidelines which is given by S1, you need to develop your own framework to report on sustainability. Especially the targets need to be identified, and it should be reported how well you are achieving those targets in your over the period of time. So structure is consistent with TCFD, that is climate related financial disclosures. And we'll come back to the governance disclosures where we will look at who is responsible at the board level. So we make the board of management accountable for this sustainability reporting and management oversight mechanism, to what extent they are involved in sustainability reporting, monitoring processes and control systems adopted in order to make sure that the governance is very much keen on developing this sustainability application in organization, and demonstrate accountability is the most significant expectation on governance of disclosures of the sustainability. So having stated that, strategy disclosures are coming up over here, where we are looking at from long term. If you are looking at the course of action that the organization is supposed to be taking into account, so entities must explain how sustainable risk affect the business model. Every organization has a way of conduct in business and how well they are providing their services to their customers and generating profit. So the business model, what they have developed, whether it is embed the amount of sustainable applications, have to be reported well. Value chain system, as you know, the primary activities and the supporting activities all leading to some connection with the value chain system. Therefore, the value chain system is supposed to be addressed in your sustainability reporting. And financial performance, how well they are achieving their targets or financial implications of these strategies also need to be identified. Long-term strategies also need to be mentioned in different periods. Maybe you can divide this into 2 to 3 years, or you can divide into 5 to 7 years. In that way, the long-term strategy also need to be explained in that. In entities are expected to be disclosed the adaptability of this strategy. To what extent their resilience to this strategy also need to be identified here. So risk management disclosures, again, when I come to the third element of that, identify the risk and assess the impact of the risk and prioritize it and see whether it has to be addressed immediately, and integrate those risk into sustainability into overall risk management activities. So you can see you must try your level best to reduce it towards the lower level from the high level by adopting a suitable strategy. And scenario analysis may be useful for you to identify how well you can deal with this type of different risk. Having said that, I am coming back to metrics and targets over here. So here, what do you mean by metrics and targets? It's a quantifiable guidelines which we are trying to develop in order to help the company to come out with their action towards supporting for the sustainable activities. Say, for example, if you are seeing that you are damaging the environment by increasing the carbon emission, right? So you can go by different levels. So to eliminate this carbon effect, what actions you have taken and how well you have been supported for this carbon emission. So greenhouse gas emission can be eliminated by different levels. So that is leading to metrics. So the metrics are required by ISSB standards, and it is an entity specific. It is cannot be identified as a common uh, format like what we are looking at from balance sheet and income statement. It's supposed to be entity specific. Organization to organization, it's vary. Targets and processes need to be taken into consideration in that particular matrix what we deal with that. So no ISSB matrix exists at the moment, and sustainability accounting standards board guidelines may be used if it is not available in line with ISSB. IFRS S2 is also leading to a climate related issues. Now, as you all very well know, that climate issue is a major problem for most of the countries, and they are expecting this organization, big companies, corporate companies, to give a due respect for not to create any sort of an impact on the climate issues. So global warming, water level going up, reduction in drinking water level coming down, and excess usage of water, And these are going to be a severe problem in the future. For the next generation, it is going to be a big headache. So how that we have to deal with that climate issues. And don't allow that, say, water sea level is going up because of melting of these ice in the North and South Pole. So these are supposed to be addressed, or we need to be ready for giving face for these kind of challenges. So IFRS is to require disclosure in climate related risks and opportunities affecting enterprise value, and built into climate related financial disclosures, and also impact on climate and dependencies on climate need to be clearly reported in S2. And climate changes which is taking place into in modern world, you can see flash flood, heavy rain, unexpected rain, and within that 5 years many countries have been faced a lot of issues. Even recent past, the Gulf countries are experiencing heavy rain which is not happened 10 years ago. So these are some of the new things. The monsoons are getting extended, and unexpected climate changes are also taking place. So these are going to be a severe impact. So transition risk and physical risk both need to be really addressed by the organization. What do you mean by transition risk? You are moving from your policy. What is the policy that you adopted before pertaining to sustainability is not what you are doing it now. So the policies changing in your corporate policies, which is going to be giving due respect for sustainability, and how the legal arrangements in the countries are being adopted with the technological changes. We are using AI in most of the platform, how that is going to be having a significant impact on our climate issues, and also market and reputational risk when you are moving towards another different way of providing services and goods. And these are supposed to be, first of all, address it. And physical risk, as you know, the acute events and long-term climate changes need to be immediately addressed by corporate companies. Both can affect the financial performance of your company. And climate is an opportunity, as I told you, when you are being able to reduce your carbon emission, that will be identified as a reputational benefit for the organization, and they can produce a product, and that product will be recommended and also getting the quality certification in many jurisdictions. So it is going to be an opportunity for you. Renewable energy is now become very famous, and that's supposed to be followed or to be taken by many organizations as a whole. And resource efficiencies, now we have to make sure that resources are utilized effectively, and also the output should be increased with the less amount of input. So we need to be very efficient in using resources in a very careful manner. Green finance, when you are looking at from the banker's point of view, okay, the more organizations are approaching the bank to get the facilities, they will give first priority for, especially for the companies with adapted with sustainability. So the green finance will be very much now becoming very famous in the banking industry. And climate strategy disclosures are, say, transition plans supposed to be reported well, how well you have gone to the next level of transition, and how that is affecting the organization in terms of finance. And climate targets have to be set, and adaptability, resilience to climate scenarios. So if there is a huge rain, and if there is a huge flash floods, how well we can give face to that. And expected financial impact also been reported under the climate strategy disclosures. And now this is the example which I told you. Your matrices and targets should be set under the scope 1, scope 2 limitations. So we can have this carbon emission under the different levels. So also you can see transition risk exposure and physical risk exposure, capital deployment, how much money you have invested in order to achieve the scope 1, 2, and 3. And also internal carbon pricing. So to eliminate the carbon effect, you need to spend or invest a lot. So how much is the price that you paid for every ton of removing the carbon from your mass production activities? And executive remuneration linkage, it is there in the next slide as well, where we need to encourage the management or the director board to be deal with this sustainability and like the bonus or whatever the encouragement has to be given for the executive management to give serious importance for sustainability reporting. And internal carbon pricing, as I told you, the internal carbon pricing assigned financial value to emissions, especially investment decisions, strategy evaluation, and capital allocations are going to be decided based on how well you are giving respect for this internal carbon pricing. So executive remuneration, as I stated very clearly, you need to give some kind of incentives and encouragement and to make them to be generated some amount of return for themselves by adapting sustainability issues and thinking in long term for the organization. So intergenerational responsibility should be taken by the executive management. So decision usefulness, your information which is given in sustainability should be predictive enough. So as part of the relevance, the predictable information should be helpful for the investors to make decisions. And the relevant information is supposed to be reported by the organization where it is not confusing the investors and lenders. And comparable information and neutral information supposed to be given. As you know, reporting on sustainability is not a straightforward thing. It has a limitation on its own. So climate information involves uncertainty, as you know. It is affect or not affect is going to be highly depends on how well the changes. That mean it is connected to the planetary impact, isn't it? So, and also future scenarios cannot be predicted with precision. We will not be able to see the very close connectivity. We predicted something would happen. So in that case, we cannot be pinpointed and say this effect will be taking place for definitely. Judgments and assumptions are very important in sustainability reporting. Therefore, we need to make sure that we need to consider the assumptions very closely into consideration. Transparency is therefore very critical because everything cannot be transparently reported, because once you give the promise, you must stand up or you must stand by that. So otherwise, it will be leading to criticism of an organization. So corporate reporting system, the effective sustainability reporting requires data governance, because big data, we are talking about the new massive data in corporate companies nowadays. Internal control system. So as per, sorry, this COSO regulation supposed to be implemented in order to have this internal control system to be designed properly by addressing all the requirements. And technology and system will have to also be taken into consideration, and cross-functional collaboration. So we need to give goal congruence. I mean, the importance for every other departments dealing with this kind of a sustainability issues need to be collectively taken into account. So financial terms play a central role in this kind of a reporting system. And also remember the assurance, audit assurance is another one important thing. We are, as of now, which a modern world is now expecting the sustainability report also to be given assurance. But we are giving a limited assurance. It cannot be given to the great extent the reasonable assurance. But if in time comes, yes, the reasonable assurance also may be expected for these sustainability issues, because it will be embedded like as 100% part and parcel of your financial reporting framework. So external auditors increasingly involved in these sustainability issues now. And what are the skills required to deal with this sustainability? Actually, it is a very crucial part. It is not an exhaustive list which I am talking about. The climate analysis has to be done properly with the support of expert, and so some kind of people from the research platform has to be involved in climate analysis, and risk management is going to be the main focal point of this sustainability. And data management, or how well the management can deal with data, and big data should be taken with the support of AI and streamlining in such a way to make those data beneficial for making decisions in sustainability. And reporting framework supposed to be created in this case. So, as a key takeaway from this particular webinar, what you can identify from the discussion so far what we had, sustainable reporting is now part of financial reporting. It is not going to be stand apart, not like the CSR that you have adopted, corporate social responsibility you adopted before. It is embedded with integrated reporting style. Every organization supposed to critically think about that sustainability to be embedded with the financial reporting framework. And S1 provide general disclosure framework where as a sustainability as a main heading to what extent that you will come out with the disclosure requirements. And climate specific disclosures are very important for the organization which are dealing with some activities which directly connecting to the climate issues. And purpose is to inform investor decision making, because three people I told you very clearly: investors, regulators, and lenders are mainly focusing on these IFRS regulations because they want to make sure their decisions are not going wrong. And sustainability is now strategic financial discipline. So it is no more as a voluntary platform like CSR. It is now becoming very serious issue, and it should be addressed properly by organizations. It is not affecting the organization alone. It is affecting every human being, every living species, where we need to give due respect for the entire global. I would like to complete with a one example. Why? Because I did not use much example because of the limitation of timing. This IKEA, the organization which the dealing with all the furnitures and from the uh, IKEA is a one famous furniture manufacturer from Sweden. And this organization and adapted with the sustainability reporting, uh, people, planet, positive, people and planet positive. So which is going to be created 2030, a comfortable environment for everyone, every living being to be live comfortably, and also make sure that they are not creating any type of an activity which is hazardous to the entire global process. So with that example, my dear participants and also the Univetena organizers, I will be finish my presentation. I welcome your questions.
Yeah, so thank you very much, Dr. Gnanendran, for such an insightful session today. And as we discussed earlier, as we mentioned earlier in the webinar, that you can put your questions into Q&A box. We have